Hey everybody, Terry the Real Estate Guy. Hope you're having a great day today. Listen, we are going to jump in. I'm going to show you a real cool little exercise if you're buying a home today on what would happen if you bought a house at 3%, 4%, 5%, and an insane number at 6%. Let's assume that interest rates go up over time. I'm doing this to show you whether you should buy now or buy in the future. So let's jump in, shall we? First, I want to show you what the rates are doing. And right now, the rates, the 30-year fixed rate mortgage, at the end of January 7th, 2021, was 2.65%. But if you fast forward to February 25th, you can see that the 30-year fixed rate mortgage has gone up about 32 basis points. For those of you who have watched my other videos, a basis point is 1/100th of a percent. So 32 basis points is like saying we're going up, rates have gone up about 1/3 of a percent. This exercise I want to show you today, however, talks about if you had a loan at 3%, 4%, 5%, and 6% and wanted to stay around a certain payment, what would your affordability options be in those four scenarios? Okay, so let's jump right in. I'm going to show you a loan amortization schedule here. And you all maybe have seen this before in previous videos, but I like this and I'm gonna link to it down below and you can mess around with the math. If you wanted to keep your payment right here around $1,264, call it $1,265 to $1,275, that's where I wanna keep my payment. You can get a $300,000 mortgage at 3%, 30-year fixed, and obtain that monthly mortgage payment with principal and interest only. I'm not counting taxes or insurance, just principal and interest. What happens if the rate goes up by 1 point? In order to keep the same payment, you're looking at an annual interest rate of 4%, but you can only buy a $265,000 house, or you can only have a loan amount of $265,000. So obviously there's a down payment scenario here, but this is talking about your loan amount. Let's jump up one. Let's look at 5%. 5% a couple years ago would have been a bargain. Let's check this out. $236,000 loan amount would equal about a $1,267 payment within a couple dollars of the last one. And finally, if you look at the amortization schedule 4, I'm not thinking we're going to hit 6% interest rates anytime soon, but I wanted to give you a crazy example because when I first bought a house, 6% would have been an insane bargain. That would yield you a $211,000 house. So let's review. $211,000 loan amount. Sorry, I keep saying house, but loan amount at 6%. $236,000 at 5%, so you can afford another $25,000 approximately. You can afford almost another $30,000 at 4%, and you can afford almost another $35,000 in loan amount at 3% if you wanted to stay around a $1,260, $1,265, $1,270 mortgage payment with principal and interest only. Brings up the question, doesn't it? Should you buy now or should you wait? I'm here to tell you, I don't think there's going to be this massive housing crash like many predict. The government basically is pouring too many resources into keeping people into their homes right now. So all the stuff that you see, clickbait on YouTube about a housing crash, don't believe it. It's not going to happen. What's going to happen is the government is going to try to stimulate the economy because of COVID, and they're going to try to keep people in their homes, and they're going to pass those stimulus measures in order to do so. At least that's the way it looks like it's going. So my question to you then would be, is it worth it to go ahead and buy now? And one other thing you really want to consider is you want to consider the amount of interest that you're paying off. So let's analyze what that would look like. After 7 years, so let's just call it 7 years of good, faithful payments, your interest payment, you've actually paid $58,000 in interest, and you've paid $48,000 in principal. I'm just using kind of round math, so you can kind of see the differences in a big picture macro view. This is after 7 years of ownership. At 4%, you have $69,000 in interest payments and roughly $37,000 in cumulative principal pay down. So you can see the difference there. At 5%, you are looking at almost $78,000 in interest at that point, and only $28,500 in principal pay down. And then at the 6% crazy rate, we're talking $84,000 in interest payments and about $22,000 in principal pay down. So let's just use two realistic figures. Let's just throw this one out. And let's keep this one because this is today's rate, the 3%, right? So we'll keep that one, and let's say that 5% is in the realm of possibility. So I'm going to use these two. If you buy today, $78,000, you're going to pay $20,000 less interest if you buy today, which is like getting a house on sale. It's like paying $20,000 less for the house, and you're paying $48,000 towards your principal versus $28,000 towards your principal. So almost $20,000 towards your principal pay down. That is not like getting a discount on the house. The interest rate gives you a little bit of the discount. The principal pay down, you would pay principal pay down no matter what kind of loan you have, you would pay the principal pay down. Does that make sense? I only bring that up to you because my take on this is that we are not going to see a housing crash. We might see a housing correction, and the reason we're going to see a housing correction is because of interest rates. If the banks start raising the rates, or the Federal Reserve starts raising the rates, then all of a sudden prices are going to stabilize to some degree. It's going to pull buyers off the fence. It's going to cause houses to kind of stop going up. Look, what is the one thing that the government tries to control? Interest rates. And they have the ability to control the interest rates with the Federal Reserve. So all that said, I'm telling you right now that we're not going to see a housing crash. We are going to see interest rates go up, and we're going to see housing start to kind of level off because those interest rates go up. I showed you the analogy here, right? There's no way that your interest rates are going to go up 2 percentage points and have it not impact housing in a negative way. We have to get back to some sort of balanced market, but it will be interest rates that causes a housing correction. All right, I'm Terry, the Real Estate Guy. If you found value in this, would you please hit that like button and share it? What that will do is it will let YouTube see it and share it with other people because you liked it. Other people might like it too that are looking at the same types of videos. All right, I hope you have a great day. Your time is valuable. Thanks for spending it with me. Is 1/100%. 32 basis points is basically like saying we're up 1/3. Shoot, daggone it. Ah!